One of the most impactful things when it comes to home prices, in terms of the market value of home prices, is interest rates. And one of the things that the Fed said they're going to do in 2022 is raise interest rates. Hi, my name is Pascal Manigat, and you're watching the Financial Ownership Podcast. And in this video, I'm going to be talking in particular on what things and factors can actually play a part and a major part into the housing market. We have seen some crazy price increases from 2020 and 2021, and some of the price increases are close to 20%, and there's been an average about a 13.9% increase in home prices throughout the year. And the funny thing is, if you try to get a home, your actual mortgage payment would be cheaper. And the reason why is because interest rates lowered again from 2020 to 2021. So the interest rates are lower now than they were even before in 2020. So some people are paying below even 3% for their mortgages for the homes. So that means they're able to, even with less money, qualify for a mortgage on a high-priced home because they're able to lock in some of these historically low interest rates that we're seeing right now. So even though home prices have increased, people are still having cheaper monthly payments, which is kind of strange when you think about it like that. So let's look at 4 factors on what actually influences the housing market. So let's start with the first factor. Obviously, supply and demand is a factor for almost every single type of product or service when it comes to how a product is priced. So based on how many people want a certain product or service, that's going to determine a lot of the value of what particular products are getting sold for. And this is why we see this crazy house boom now, because there's a lot of demand for homes nowadays and not enough supply to fill it, because we've had a lot of things like supply chain issues with people getting back to work, and all these things has contributed to slower creation of products and services. So when you're looking at the supply of homes, there's 3 things that you might want to look at. There's one, which is foreclosures, people that can't afford their homes and are forced to sell their homes, which also increases the supply of homes. There's 2, the home developers, the people actually building homes and manufacturing homes to make sure that they're structured in the right way so people can go out and buy homes that are fully made and optimized for people to live in. 3 is, are people actually selling the homes? Are there a lot of people actually selling it? And if you think about it today, if you want to sell your home, it's probably the best time to do it now because home prices are so high. These crazy increases aren't going to last forever, and eventually we're going to see a market correction. But that's 3 things that really determine the supply of homes and how many homes are in the market for sale. And when you look at demand, there's 2 factors. There's a few more than 2 factors, but the 2 main factors are interest rates. So interest rates are going to determine the price of the homes, because if you think about it, if home prices are high and interest rates are high, it's going to price a lot of people out of the market. So the average person that would be going out to buy a home won't be able to afford a home because the price of it is too high and the mortgage payments are going to be too high because of the high interest rates. But in the rare environment that we live in now, we see an environment where there's high home prices and there's low interest rates. So a lot of people, even with lower incomes, can still afford a home because they're able to lock in some of these historically low interest rates and buy what would previously or what would normally be above the price range. Because the interest rates are so low, they're still able to afford or pay for a decent sized mortgage, and it's still sustainable for them. And 2 is also the unemployment rate and the employment rate, and whether people actually get paid enough to buy these homes. So right now, if you look at the economy today, wages aren't keeping up at all or even close to home prices nowadays. Home prices are skyrocketing and people's wages are kind of staying stagnant. They're not even beating inflation. So how much can these crazy price increases really happen where the home prices are going up so high and people's wages aren't really increasing or keeping up with it? So eventually there is going to be a correction in the market when you look at it by a bird's eye view. So those are 2 factors that determine the demand of the home, is whether people could actually afford it, and interest rates. And these all determine whether people could actually buy the homes or not. The second thing that determines the market value of the home is the actual appraisal value, what it's actually appraised at. So the thing is, Just because someone actually wants or is willing to pay, say, $350 for a home, it doesn't really matter unless the bank approves for the loan for them to get that much. So let me break down a little bit what that means. So if a home value is appraised at $300,000 and the person is willing to buy it at $350 because, say, like, there's a lot of other buyers that are willing to buy the same home, so maybe you're bidding of other people, so maybe you had to bid up to, say, $350. And the bank, after they appraise it and look at the value of it, they're not willing to buy that home for $350. They're only willing to give you a mortgage to help you up to $300,000. So most people can't afford to buy homes in cash, right? So they're gonna have to use the bank's money. And the thing is, if the bank isn't gonna approve the actual amount that you're willing to pay for it, it doesn't really matter what you want to pay for it, because if you can't get the bank's money, you can't actually buy it at that price. So in a way, it's kind of a good thing, because a lot of people are willing to pay these higher prices for home values, even though they might not be worth that much, because they're bidding with other people. But the thing is, when the house is actually appraised, the real value that a lot of people are bidding higher against, it's not the home actually isn't worth that much. People are kind of overbidding on it, and it's kind of controlling the housing market a little bit to some extent, to make sure people aren't buying homes at a higher price than they should. And the thing is, this actually goes on to my third point. If people don't have a ton of equity inside their home, but when the price of the house actually drops, that actually puts the economy at risk a lot. Because if you think about it, if someone has a $250,000 mortgage on a $200,000 home, because, say, maybe they first originally got it for $300,000, but the housing price corrected to $200,000 later on because of these things that we're seeing with a lot of demand in the market and the inflation that we're seeing, that all contribute to the increasing prices of homes. If the mortgage that you're paying or the interest that you're paying is on $250,000 and the home value is actually $200,000, that means you're actually underwater. So, because the loan balance actually exceeds the home price, and this could potentially cause another housing crisis. And the good thing is, a lot of these appraisal reviews are getting rejected, even because people are putting in higher prices than they normally would, just because they wanted to get a house and they wanted to pay higher so they could bid higher against other people who also want that house. It's a good thing that a lot of these are getting rejected, because it's gonna at least slow down or make it less likely for there to be a complete market collapse like we see it in 2008, where basically banks lend out too much money, and if you think about it, if they're underwater, that means the banks are losing money as well. And that's why you see some banks aren't in business anymore, because if you're lending $250,000 for a $200,000 house, that makes the banks underwater. And if you keep doing that, that could potentially be a lot of risk that the bank is taking for lending out too much money for home prices that really weren't worth that value that they were actually lending out. Especially this becomes bad when people get foreclosed on and they can actually afford those mortgage payments anymore, and they end up leaving, because at the end of the day, when they have no skin in the game, they really don't have anything to lose if there's no equity in the home anymore. And the people end up leaving, that's all the bank's money that they're basically losing, and they get foreclosed on in that property, and they have to look for another way to either sell that property or rent it out or something, because at the end of the day, if people can't actually make those payments and they go underwater on it, that's lost money on their part in terms of the bank. And that's the potential risk when it comes to the rising interest rates. How high will interest rates rise? We don't really know yet, but if interest rates raise drastically, that could drastically affect home prices. And if home prices go below the mortgage value that the banks actually lend, that's actually a fear of potential of a massive housing correction or a massive housing crash. Because if the loan amount exceeds the home value, that's a very scary thing, because if a lot of people don't have anything to lose and are getting continuously foreclosed on properties, that's going to put a lot of banks underwater, and it's going to make a potentially large market correction in the future. So we'll see how interest rates change in the future. The Fed said that they're going to increase it, but also the Federal Reserve has been saying a lot of things that they haven't followed through with, and been saying a lot of things that haven't really made sense, like inflation is transitory, meaning that is it going to last forever, and it's not going to last too long. It's only expected to be very temporary. But obviously they're wrong about that too. They recently said that inflation is going to be here for a while. So it's one thing to take what the Fed says or the Federal Reserve says with a grain of salt, and make sure you prepare yourself for the worst, and based on things that are happening in the economy, prepare yourself for things that could potentially happen in the future. But really, the only reason home prices are so high is because people can somewhat afford it, I guess, because they're historically low interest rates. But at the end of the day, the home prices are only going to be able to keep up with the wages people actually make. So, and I guess that's kind of a fourth point to what I'm saying. So along with, I guess my last point would be, is how much are people actually making? Right now, wages are not keeping up with the pace of the increase of home prices. So eventually there's going to have to be a breaking point where housing prices do go down a little bit, because it can't continuously go in that trend where the housing prices are going up so much while people's wages are still not even beating inflation at the end of the day. So that's one thing to keep in mind, is those four things. So the four things I talked about was the supply and demand issue, the appraisal issues, equity issues, and wages. So those are the four topics I wanted to talk about today and how it relates to the housing market. Some other suggestions that I might have that might make sense for you to do in an economy like today is, if you have a home and you're actually looking to sell it, this is a great time to sell it now because home prices are extremely high. Or if you're looking to, say, maybe stay in your home and not necessarily sell it, lock in interest rates. Maybe refinancing is a good idea to lock in these historically low interest rates, because interest rates cannot stay this low. And if you want to take advantage of it, you might as well get the lowest interest rate possible. So even if your home value or your home prices fluctuate, you still lock in that historically low interest rate. So if you found any value in this video, go ahead, like, comment, subscribe. I post financial content every single week. So if you're interested in learning about things about personal finance, the stock market, how to use different financial products and enhance your financial situation, this is the perfect channel to follow. So feel free to leave a comment below, like this video, and if you want to contact me, in the link below or in the description below, there's a link to my link tree where you could book a call with me and ask me a question about personal finance. Thank you.